Question 1. Underwriting principles. Which of the following factors is NOT typically considered during the underwriting process for a term life insurance policy? A. Age of the applicant. B. Current health status. C. Employment history. D. Religious affiliation. Answer: D. Religious affiliation. Explanation: during the underwriting process, insurers evaluate various risk factors to determine the premium rates and eligibility for coverage. Common factors include age of the applicant. A. Older applicants usually face higher premiums due to increased mortality risk. Current health status. B. Medical history and present health conditions are critical in assessing risk. Underwriters often require medical examinations and detailed health questionnaires. Employment history. C. Jobs that involve higher risk. E.g., construction, firefighting may lead to higher premiums. Religious affiliation. D, however, is not a standard underwriting factor. Insurers must adhere to regulations that prohibit discrimination based on religion, as stated in the Fair Housing Act and other applicable laws. Understanding these underwriting principles is essential for evaluating risk accurately. Question 2. Claims process. An insurance company has denied a claim for a term life insurance policy stating that the policyholder failed to disclose a pre-existing condition. Which of the following statements about the claims process and policyholder obligations is true? A. The insurer can deny the claim only if the pre-existing condition directly caused the death. B. The policyholder must provide evidence of all pre-existing conditions, regardless of their relevance to the coverage. C. The insurer must demonstrate that the policyholder intentionally misrepresented their health to deny the claim. D. The claim can be denied at any time, regardless of when the policy was issued. Answer: C. The insurer must demonstrate that the policyholder intentionally misrepresented their health to deny the claim. Explanation: in the claims process, if an insurer denies a claim based on a failure to disclose a pre-existing condition, the following points are relevant. Intentional misrepresentation. C. The insurer has the burden to prove that the policyholder intentionally misrepresented their health at the time of application. If the omission was inadvertent, the claim cannot be denied. Direct cause. It is not sufficient for the insurer to only show that the pre-existing condition existed. They must also show that it was directly relevant to the claim. Relevance of pre-existing conditions. B. While policyholders should disclose known health issues, not all conditions must be disclosed if they do not affect the coverage. Timing of denial. D. Claims cannot be denied indefinitely. Typically, an insurer can only contest claims based on misrepresentation during the contestability period, usually 2 years from the policy issue date. This highlights the importance of honest disclosures and the insurer's obligation to support their denial with evidence. Question 3. Scenario-based question. Mr. Thompson is a 45-year-old business owner looking to purchase a term life insurance policy. He has been presented with two options: a 10-year level term policy with a $500,000 face amount and a 20-year decreasing term policy that starts at $500,000 and decreases to $250,000 over the term. Given his current financial obligations and future plans to retire at age 65, which policy would better suit his needs and what factors should he consider in making this decision? A. The 10-year level term policy is better because it provides a consistent death benefit during a critical financial period. B. The 20-year decreasing term policy is better because it aligns with his expected decrease in financial obligations over time. C. Both policies are equivalent. Mr. Thompson should choose based solely on the lower premium. D. The 10-year level term policy is better because it can be converted to a permanent policy in the future. Answer A. The 10-year level term policy is better because it provides a consistent death benefit during a critical financial period. Explanation: when Mr. Thompson evaluates these options, several critical factors must be considered. Financial obligations. A 10-year level term policy provides a stable death benefit of $500,000 for 10 years, which is crucial if he has significant debts, e.g., business loans, mortgage, that need to be covered in case of his untimely death. This option gives his family more security during a key financial period. Future financial outlook. B. While the 20-year decreasing term policy might suit someone whose debts diminish over time, if Mr. Thompson anticipates maintaining high financial responsibilities during the next decade, this policy might not provide sufficient coverage when it is most needed. Policy equivalence. C. The notion that both policies are equivalent overlooks the differences in death benefit structure and potential needs for coverage, making this option misleading. Conversion features. D. While conversion options may exist, the scenario focuses on current needs. Mr. Thompson's priority should be ensuring adequate coverage during the first critical decade rather than planning for conversion without immediate necessity. Ultimately, a thorough understanding of term insurance structures and how they align with personal financial situations is essential in making informed decisions. Question 4. Needs analysis. A client has 3 children and a mortgage of $300,000. In assessing their life insurance needs, they want to ensure their family can maintain their current standard of living and cover debts. Which of the following is the most important factor in determining the appropriate amount of term life insurance coverage for this client? A. The age of the children. B. The client's income. C. The total amount of the mortgage. D. The client's health status. Answer: B. The client's income. Explanation: when determining the appropriate amount of term life insurance coverage, income is a critical factor because B. The client's income is essential for maintaining their family's standard of living. Adequate coverage should ideally replace a significant portion of the income to ensure the family can meet ongoing living expenses, educational costs, and other financial obligations. Age of the children. While the age of the children can influence how long coverage is needed, it does not directly determine the amount of insurance required. Mortgage amount. C. Although the mortgage amount is important, it is just one part of a broader financial picture. Coverage should encompass more than just debts. Health status. D. The client's health status is vital for underwriting and determining premium costs, but does not directly affect the coverage amount needed to protect the family financially. In life insurance needs analysis, income replacement is a fundamental principle guiding the required coverage amount. Question 5. Regulatory framework. Under New Hampshire law, which of the following statements regarding the free look period for life insurance policies is true? A. The free look period is 10 days from the date the policy is issued. B. The free look period can be waived by the policyholder if they are satisfied with the policy. C. The free look period is 30 days for all term life insurance policies. D. During the free look period, the policyholder can cancel the policy without any financial penalties. Answer A. The free look period is 10 days from the date the policy is issued. Explanation: in New Hampshire, regulations stipulate free look period. A. Policyholders have a 10-day free look period starting from the date the policy is issued, allowing them to review the policy and cancel it for a full refund if they are unsatisfied. Waiver of the free look period. B. The free look period cannot be waived. It is a statutory requirement designed to protect consumers. Duration of the free look period. C. The standard duration is 10 days, not 30 days, which is only applicable to certain other types of insurance. Cancellation penalties. D. While the policy can be cancelled within the free look period without penalties, the emphasis is on obtaining a refund rather than highlighting penalties. Understanding consumer protection regulations like the free look period is crucial for both insurance professionals and policyholders. Question 6. Claims process. In the event of a claim, which of the following is the primary responsibility of the beneficiary under a term life insurance policy? A. To provide medical records of the deceased. B. To submit a written claim along with the death certificate. C. To notify the insurance company within 24 hours of death. D. To conduct an investigation into the cause of death. Answer: B. To submit a written claim along with the death certificate. Explanation: when a claim is filed under a term life insurance policy, the primary responsibilities of the beneficiary include submitting a claim. B. The beneficiary must submit a written claim form along with a certified death certificate to initiate the claims process. This documentation is crucial for the insurer to verify the claim. Medical records. A. While insurers may request medical records during their investigation, it is not the primary responsibility of the beneficiary. Notification time frame. C. There is typically no specific 24-hour notification requirement. Instead, the claim should be filed promptly after the death. Investigation. D. Conducting an investigation into the cause of death is the insurer's responsibility, not the beneficiary's. A thorough understanding of the claims process helps beneficiaries navigate their responsibilities efficiently during a challenging time. Question 7. Practical applications. Mr. and Mrs. Green are considering 2 term life insurance options for their family protection. They are looking at a 15-year level term policy and a 20-year decreasing term policy. Given their long-term financial goals, what is the most critical factor they should consider before making a decision? A. Premium differences between the 2 policies. B. The total death benefit offered by each policy. C. The likelihood of their financial obligations decreasing over time. D. The ability to convert the policy to permanent insurance. Answer: C. The likelihood of their financial obligations decreasing over time. Explanation: when evaluating life insurance options, understanding their financial situation and future obligations is essential. Likelihood of obligations decreasing. C. If Mr. and Mrs. Green expect their financial obligations, such as a mortgage or children's education, to decrease over the life of the policy, a decreasing term policy may be more appropriate. However, if they anticipate needing a consistent level of coverage to protect against debt and income loss, the level term policy may be more suitable. Premium differences. While premium costs are important, they should not be the sole determining factor. The type of coverage and how it aligns with their needs is more critical. Total death benefit. B. Understanding the total death benefit is vital, but aligning it with their long-term financial strategy is paramount. Conversion options. D. While the ability to convert to a permanent policy may be beneficial, it is not as crucial as assessing how their current and future financial obligations fit each policy type. This scenario emphasizes the importance of aligning insurance decisions with long-term financial planning. Question 8. Theoretical knowledge. Which of the following principles is not a foundational principle of life insurance that insurers must adhere to when underwriting policies? A. Insurable interest. B. Utmost good faith. C. Risk pooling. D. Indemnity. Answer: D. Indemnity. Explanation: while indemnity is a principle in property insurance, it does not apply to life insurance in the same manner. In life insurance, insurable interest. This principle requires that the policyholder have a legitimate interest in the life insured, preventing moral hazard. Utmost good faith. B. This principle mandates both parties to act honestly and disclose all relevant information during the underwriting process. Risk pooling. C. Life insurance operates on risk pooling, where the premiums from many policyholders are used to pay the claims of the few who died during the policy term. Indemnity. D. Pertains to compensating the insured for losses and does not apply to life insurance, as the death benefit is not intended to restore a financial position but rather provide a benefit to the beneficiaries. Question 9. Problem-solving skills. An insurance agent is reviewing a term life insurance policy for a client who has significant health issues and is concerned about premium costs. Which strategy should the agent prioritize to help the client obtain affordable coverage? A. Recommend a larger death benefit with a lower premium. B. Suggest a shorter term policy with a level premium. C. Advise the client to improve their health before applying. D. Encourage the client to seek coverage with a simplified underwriting process. Answer: D. Encourage the client to seek coverage with a simplified underwriting process. Explanation: for clients with significant health issues, managing premium costs can be challenging. The agent should consider simplified underwriting. D. This process typically requires less medical information and may offer quicker approvals. It is advantageous for clients with health concerns who may not qualify for standard underwriting. Larger death benefit. A. Recommending a larger death benefit is unlikely to help with costs. Premiums would likely increase significantly. Short-term policy. B. While short terms may reduce premiums, they may not align with the client's long-term coverage needs. Health improvement. C. While improving health can lower premiums in the long run, it may not be practical or immediate for the client seeking coverage now. This question underscores the importance of understanding different underwriting options available to assist clients effectively. Question 10. Unique aspects of term life insurance in New Hampshire. In assessing the life insurance market in New Hampshire, which of the following factors has the most impact on term life insurance pricing and availability? A. Historical claims trends within the state. B. National regulations governing insurance practices. C. Local economic conditions and demographics. D. Competition among insurance providers. Answer: C. Local economic conditions and demographics. Explanation: the term life insurance market is significantly influenced by local factors including local economic conditions. C. Economic stability, employment rates, and demographics affect overall insurance demand, pricing, and the risk pool insurers consider when setting premiums. Historical claims trends. While important, claims trends typically reflect the past and do not directly influence pricing as significantly as current economic conditions. National regulations. B. Although they set overarching rules, local market dynamics play a more immediate role in pricing strategies. Competition among providers. D. Competition does affect pricing but is ultimately shaped by local economic conditions and demographics. Question 11. Policy riders. a client is interested in adding a waiver of premium rider to their term life insurance policy, what is the primary benefit of this rider? A. It increases the death benefit payout. B. It allows the policyholder to skip premium payments if they become disabled. C. It extends the term of the policy without additional cost. D. It provides a cash value accumulation feature. Answer B. It allows the policyholder to skip premium payments if they become disabled. Explanation: a waiver of premium rider ensures that if the policyholder becomes totally disabled, they do not have to pay premiums during the period of disability. This maintains the policy in force without the financial burden of premium payments. Increased death benefit. A. This rider does not affect the death benefit amount. Extending term. C. The rider does not extend the term. It merely allows for premium payments to be waived. Cash value accumulation. D. Term life policies do not accumulate cash value, making this option irrelevant. This rider is valuable for clients concerned about maintaining coverage during financial hardships caused by disability. Question 12. Policy conversions. Mr. Johnson holds a 20-year term life insurance policy that is nearing its expiration. He is considering converting it to a whole life policy. What is a key advantage of converting his policy? A. Low premiums compared to new term policies. B. Guaranteed acceptance regardless of health changes. C. Increased death benefit at no additional cost. D. Access to cash value immediately. Answer B. Guaranteed acceptance regardless of health changes. Explanation: converting a term policy to a permanent one often comes with the significant advantage of guaranteed acceptance. This means Mr. Johnson will not have to undergo medical underwriting, which is crucial if his health has deteriorated since the original policy was issued. Low premiums. Say, premiums for whole life policies are generally higher than those for term policies. Increased death benefit. C. The death benefit typically reflects the new policy's terms and conditions and may not increase without additional costs. Access to cash value. D. Cash value accumulation occurs in whole life policies, but it is not available immediately upon conversion. It builds over time. Understanding the benefits of conversion options can help clients make informed decisions about their insurance needs. Question 13. Underwriting considerations. In underwriting a term life insurance policy, which of the following factors is AST likely to be considered? A. Family medical history. B. Lifestyle habits, such as smoking or alcohol use. C. The applicant's occupation. D. The applicant's favorite hobbies. Answer D. The applicant's favorite hobbies. Explanation: while hobbies can sometimes be considered, they are generally not as critical as the other factors listed. Family medical history. A. This is a significant factor as it can indicate potential genetic risks for certain illnesses. Lifestyle habits. B. Smoking and alcohol use greatly influence underwriting decisions due to their impact on mortality risk. Occupation. C. Certain occupations can be riskier and influence the underwriting process. Favorite hobbies. D. While some high-risk hobbies might be considered, they are less relevant compared to the other factors. Understanding the factors that affect underwriting can help applicants prepare for the application process. Question 14. Regulatory compliance. Which of the following is a requirement for insurance agents selling term life insurance in New Hampshire? A. Completing a minimum number of annual continuing education credits. B. Offering a free trial period to clients. C. Providing financial advice as part of the policy sale. D. Guaranteeing policy approval regardless of health status. Answer A. Completing a minimum number of annual continuing education credits. Explanation: insurance agents in New Hampshire must adhere to regulatory requirements, which typically include completing a certain number of continuing education credits to maintain their licenses. This ensures they remain informed about current laws, products, and best practices. Free trial period. B. There is no requirement for agents to offer trial periods for policies. Providing financial advice. C. While agents can offer guidance, they are not required to provide comprehensive financial advice. Guaranteeing approval. D. Agents cannot guarantee policy approval, as underwriting will depend on various factors including the applicant's health. Compliance with continuing education requirements is essential for maintaining professionalism and effectiveness in the insurance industry. Question 15. Tax implications. What is the tax implication for a beneficiary receiving a death benefit from a term life insurance policy in New Hampshire? A. The death benefit is subject to federal income tax. B. The death benefit is subject to state income tax. C. The death benefit is generally received tax-free by the beneficiary. D. The death benefit may be taxed if the policyholder had a taxable estate. Answer C. The death benefit is generally received tax-free by the beneficiary. Explanation. Typically, death benefits from life insurance policies are not subject to federal or state income tax when paid to beneficiaries. This feature makes term life insurance a popular choice for providing financial security to loved ones. Federal income tax A. Death benefits are usually not taxable as income. State income tax B. There is no state income tax on death benefits. Taxable estate D. While the benefit itself is tax-free if the policyholder's estate exceeds federal estate tax limits, the overall estate may be subject to taxation, but this does not apply directly to the beneficiary receiving the death benefit. Understanding the tax implications of life insurance is essential for both policyholders and beneficiaries. Question 16. Premium payment structures. Which of the following premium payment structures is typically available for term life insurance policies? A. Single premium. B. Flexible premium. C. Level premium. D. Variable premium. Answer C. Level premium. Explanation. Term life insurance policies commonly feature level premiums, meaning the premium amount remains consistent throughout the policy term. This allows policyholders to budget effectively. Single premium A. While some policies may offer single premium options, this is not standard for term insurance. Flexible premium B. This structure is more commonly associated with permanent life insurance policies, allowing for varying premium payments. Variable premium D. This option is not typical in term policies, which do not accumulate cash value or allow for variations based on investment performance. Understanding premium payment structures is crucial for selecting an appropriate policy. Question 17. Policy lapse and reinstatement. What is the typical time frame within which a term life insurance policy can be reinstated after lapsing due to non-payment of premiums in New Hampshire? A. 30 days. B. 60 days. C. 90 days. D. 1 year. Answer C. 90 days. Explanation. In New Hampshire, most insurance companies allow a grace period of 30 days for premium payments, and a policyholder typically has 90 days from the lapse to reinstate their policy, provided they meet certain conditions, such as paying past due premiums and potentially providing evidence of insurability. 30 days A. This is the grace period for premium payments, not the reinstatement period. 60 days B. This does not reflect the standard reinstatement time frame. 1 year D. While some companies may allow longer periods, 90 days is a common standard for reinstatement. Awareness of lapse and reinstatement policies helps consumers maintain their coverage. Question 18. Replacement of policies. When replacing a term life insurance policy, what is the primary obligation of the agent under New Hampshire regulations? A. To ensure the new policy has lower premiums. B. To provide a written disclosure explaining the reasons for replacement. C. To cancel the existing policy on behalf of the client. D. To guarantee the client will receive the same benefits in the new policy. Answer B. To provide a written disclosure explaining the reasons for replacement. Explanation. When an agent recommends replacing an existing policy, they are required to provide a written disclosure that details the reasons for the replacement. This protects consumers by ensuring they are aware of the implications of changing their coverage. Low premiums A. While low premiums may be a reason for replacement, the agent cannot guarantee this as a requirement. Cancelling the existing policy. C. It is the client's responsibility to cancel the old policy if they choose to do so, guaranteeing benefits. D. Agents cannot guarantee that the new policy will offer the same benefits as the existing one. A policy comparison is necessary. Understanding regulations regarding policy replacement is critical for ethical and compliant practice. Question 19. Market trends. Which factor is AST likely to influence market trends in term life insurance in New Hampshire? A. Advances in medical technology and healthcare. B. Economic downturns affecting disposable income. C. Changes in consumer awareness and preferences. D. Historical performance of life insurance stocks. Answer D. Historical performance of life insurance stocks. Explanation. While historical stock performance can affect the overall insurance industry, it is less likely to directly influence market trends for term life insurance specifically. The other options are more impactful. Medical technology A. Advances can change underwriting criteria and the perceived risk associated with certain health conditions affecting policy, pricing, and availability. Economic downturns B. Economic factors directly affect consumers' ability to purchase insurance and influence market demand. Consumer awareness. C. Changes in consumer preferences and knowledge about term life insurance can significantly shape market offerings and trends. Historical performance of life insurance stocks D is more relevant to investors and company profitability than to the trends influencing consumer purchase decisions for term life insurance policies. Question 20. Understanding policy types. What is the primary distinction between level term life insurance and decreasing term life insurance? A. Level term insurance provides a death benefit that remains the same, while decreasing term insurance provides a death benefit that decreases over time. B. Level term insurance has higher premiums than decreasing term insurance. C. Level term insurance can be converted to permanent insurance, while decreasing term insurance cannot. D. Level term insurance is available only for a maximum of 10 years, while decreasing term insurance can be issued for longer terms. Answer A. Level term insurance provides a death benefit that remains the same, while decreasing term insurance provides a death benefit that decreases over time. Explanation. The fundamental difference between level and decreasing term life insurance lies in the death benefit structure. Level term insurance maintains a consistent death benefit throughout the term, while decreasing term insurance has a death benefit that gradually declines, often in alignment with a mortgage or other debts. High premiums B can vary based on individual factors and the insurer rather than the type of insurance. Conversion options C may depend on specific policy provisions and are not universally applicable. Term limits D are not accurate, as both types can be issued for various term lengths. Understanding these distinctions helps clients choose the right policy based on their financial needs and circumstances. Question 21. Insurable interest. What is the concept of insurable interest in life insurance, and why is it important? A. It refers to the amount of coverage a person can purchase. B. It requires that the policyholder will suffer financial loss if the insured dies. C. It allows a policyholder to name any beneficiary without restriction. D. It determines the length of the insurance policy. Answer B. It requires that the policyholder will suffer a financial loss if the insured dies. Explanation. Insurable interest is a fundamental principle in insurance that ensures the policyholder has a legitimate interest in the continued life of the insured. This means that the policyholder would suffer a financial loss upon the death of the insured, which prevents insurance from being used as a gambling tool. Without insurable interest, the insurance contract would be void. Coverage amount A does not relate to insurable interest. Naming beneficiaries C is a separate matter. Insurable interest applies to the policyholder's relationship with the insured. Length of policy D is determined by the terms of the contract, not insurable interest. Question 22. Contestability period. What is the significance of the contestability period in a term life insurance policy? A. It allows the insurer to refuse claims for any reason. B. It permits the insurer to investigate claims without time constraints. C. It restricts the insured from changing beneficiaries during the period. D. It provides a period during which the insurer can contest a claim based on misrepresentation. Answer D. It provides a period during which the insurer can contest a claim based on misrepresentation. Explanation. The contestability period, typically lasting 2 years from the policy's issuance, allows insurers to investigate and potentially deny claims if the insured made material misrepresentations on their application. After this period, the insurer generally cannot contest the claim, making it a crucial aspect of the policy. Refusal of claims A is not unlimited. The contestability period has specific grounds. Investigating claims B is not without time constraints, as it's tied to the contestability period. Beneficiary changes C are not restricted during this time, as the policyholder can typically make those changes. Question 23. Death benefit options. Which of the following statements is true regarding death benefit options in term life insurance policies? A. All term life policies only offer a lump sum payment at death. B. Some policies allow for installment payments to beneficiaries. C. Term policies do not allow for any options other than a single payout. D. Death benefits are always taxable to the beneficiary. Answer B. Some policies allow for installment payments to beneficiaries. Explanation. While many term life insurance policies provide a lump sum payment upon the insured's death, some policies offer options for beneficiaries to receive the death benefit in installments. This can help beneficiaries manage the funds over time. Lump sum only is not accurate, as there are policies with flexible payment options. Term policies C may indeed have payout options, contrary to this statement. Tax implications. D. Indicate that death benefits are generally received tax-free except under specific circumstances. Question 24. Premium payment frequency. How does the frequency of premium payments affect the overall cost of a term life insurance policy? A. More frequent payments generally lower the total cost of the policy. B. Annual payments typically incur higher costs than monthly payments. C. Premiums paid quarterly often include additional fees compared to annual payments. D. Payment frequency has no impact on the overall cost. Answer C. Premiums paid quarterly often include additional fees compared to annual payments. Explanation. Most insurance companies offer a discount for annual premium payments because they reduce administrative costs. Conversely, paying premiums monthly or quarterly can sometimes result in additional fees, making the overall cost higher compared to annual payments. More frequent payments generally lead to higher total costs due to additional administrative fees. Annual payments B are typically lower than monthly or quarterly payments. Payment frequency D does affect costs due to the reasons stated above. Question 25. Accelerated death benefit. What is an accelerated death benefit rider in a term life insurance policy? A. It allows the policyholder to increase their death benefit amount. B. It enables the insured to receive a portion of the death benefit while still alive if diagnosed with a terminal illness. C. It provides a bonus payout if the policyholder lives beyond a certain age. D. It guarantees a refund of premiums paid if the insured does not die within the term. Answer B. It enables the insured to receive a portion of the death benefit while still alive if diagnosed with a terminal illness. Explanation. An accelerated death benefit rider allows policyholders diagnosed with a terminal illness to access a portion of the death benefit early to help cover medical expenses or other costs. This feature provides financial support during critical times. Increasing death benefit is not the purpose of this rider. Bonus payouts C. do not apply to accelerated death benefits. Refund of premiums D is a different concept and not related to this rider. Question 26. Policy termination. Under which circumstance can a term life insurance policy be terminated by the insurer? A. The insured moves to a different state. B. The insured fails to pay premiums after the grace period. C. The insured has a change in occupation. D. The insured requests a policy change. Answer B. The insured fails to pay premiums after the grace period. Explanation. If the insured does not pay premiums within the grace period specified in the policy, the insurer can terminate the coverage. This highlights the importance of maintaining premium payments to keep the policy in force. Moving typically does not affect the policy unless state regulations are violated. Change in occupation C might impact underwriting but does not directly lead to termination. Requesting policy changes D does not lead to termination. Rather, it may lead to amendments or adjustments. Question 27. Non-forfeiture options. What are non-forfeiture options in life insurance and how do they apply to term policies? A. They allow the policyholder to receive a cash value if they cancel their term policy. B. They are not applicable to term life insurance as term policies do not accumulate cash value. C. They guarantee that premiums will not be increased throughout the policy term. D. They provide a refund of premiums upon cancellation of the policy. Answer B. They are not applicable to term life insurance as term policies do not accumulate cash value. Explanation. Non-forfeiture options apply primarily to permanent life insurance policies that accumulate cash value. Since term life insurance does not have a cash value component, these options are not relevant. Cash value A is incorrect because term policies lack cash value. Premium guarantees C do not relate to non-forfeiture options as they pertain to cash value policies. Refunds of premiums D might be possible in specific circumstances but are not considered a non-forfeiture option. Question 28. Life settlement. What is a life settlement in the context of term life insurance? A. It is the process of exchanging a life insurance policy for cash. B. It refers to the termination of a policy due to unpaid premiums. C. It is the assignment of a policy to a bank as collateral for a loan. D. It involves selling a life insurance policy to a third party for more than its cash surrender value. Answer D. It involves selling a life insurance policy to a third party for more than its cash surrender value. Explanation. A life settlement occurs when a policyholder sells their life insurance policy to a third party for a lump sum that exceeds the policy's cash surrender value but is less than the death benefit. This option provides liquidity for those who no longer need or want their coverage. Exchanging for cash can be misleading, as life settlements typically involve selling the policy, not merely exchanging it. Termination due to unpaid premiums. B. Does not define life settlements. Assignment of a policy. C. Is not the same as a life settlement. It relates to using the policy as collateral. Question 29. Federal regulations. Which federal regulation primarily governs the advertising of life insurance products? A. Fair Credit Reporting Act. B. Truth in Lending Act. C. Model Advertising Regulation. D. Privacy Rule. Answer C. Model Advertising Regulation. Explanation. The Model Advertising Regulation, developed by the National Association of Insurance Commissioners (NAIC), outlines guidelines for the advertisement of life insurance products. These regulations ensure that advertisements are not misleading and provide accurate information to consumers. The Fair Credit Reporting Act A deals with credit reporting and consumer privacy but does not specifically govern insurance advertising. The Truth in Lending Act B focuses on credit terms and is not applicable to insurance. The Privacy Rule D relates to consumer data privacy, not specifically to advertising. Question 30. Ethical practices. What is the primary ethical consideration for insurance agents when selling term life insurance? A. To maximize their commissions on policy sales. B. To provide accurate and clear information to clients about policy features and risks. C. To pressure clients into purchasing higher coverage amounts. D. To ensure all clients are eligible for the lowest premiums available. Answer B. To provide accurate and clear information to clients about policy features and risks. Explanation. Insurance agents have an ethical obligation to present accurate information regarding policies, including benefits, limitations, and risks. This ensures that clients can make informed decisions about their coverage based on their unique needs. Maximizing commissions is not an ethical practice. Agents should prioritize the needs and best interests of their clients over their own financial gain. Pressuring clients into purchasing higher coverage amounts can lead to inappropriate sales and may not serve the client's actual needs, which is unethical. Ensuring all clients are eligible for the lowest premiums available D is not feasible or always in the best interest of every client, as premium rates depend on various factors including health, age, and risk assessment. Agents should focus on providing the best advice and suitable options for each client's situation.